Jai Shri Gurudev. Welcome back to my YouTube channel. This is Ravi N, Assistant Professor, Department of Commerce and Management, BGSIMS, Chikaballapur. Dear students, in this video, I am going to explain the concept credit risk management and elements of credit risk management. Okay, before stepping to the elements of credit risk management, let me explain the meaning of credit risk management. See, credit risk management, it is the practice of mitigating losses by understanding the adequacy of a bank's capital and loan loss reserves at any given time. See, the credit risk majorly it is happened in a banks. So this is a situation arises in a banking sector or a financial institutions which are dealing with financial transactions, or the companies which are dealing with the financial transactions. So that it is the practice of mitigating the losses. Mitigating means reducing, controlling, managing. So they are going to manage or mitigate, control, reduce the losses by understanding the adequacy of a bank's capital. See, why it is necessary to understand the adequacy of the bank's capital in the sense, so based on the adequacy of bank's capital only they can lend a loan to the customers, that is for companies or any other business icons. So here, if the bank's adequacy of when a bank's capital is adequate, then they can easily lend a loan. And if there is a loan loss reserves, they can manage somehow. So if not, definitely they has to go for further funds. So here, in order to mitigate the losses by understanding the adequacy of the bank's capital and loan loss reserves at any given time, it is what an credit risk management. This is how they can manage their credit risk. Okay, in simple terms, it is understood as a process. It is the process. Which is the process? Credit risk management is the process. It is the process of what? Identifying and analyzing risk factors. So the risk management itself is a process of identifying the risk and analyzing the risk factor. So here also same thing, credit risk management is the process of identifying and analyzing the risk factors, measuring the risk level of risk, thereby selecting measures to manage credit activities to limit and eliminate the risks in the credit process. See, anyhow, so the organization or a financial institution is going to analyze the risk factors, and they're going to measure the level of risk included in the financial transactions in which they are going to deal with. Thereby they're going to select the measures to manage that credit activities to limit and eliminate the risk factors included in that and risk in the credit process. So this is what the credit risk management is. In simple words, just it is the process of identifying and analyzing the risk factor to reduce the risk involved in the financial transactions. So that is what risk management is. And next concept is elements of risk management. That is credit risk management. Elements of credit risk management. It is also known as process of credit risk management. There are 6 steps. There are 6 elements of credit risk management. Let me explain one by one. First one is know your customer. I think you might have known this terminology, KYC, know your customer. Any financial institution's legal obligation is to know their customers well in advance before lending any loan to them. Before lending any loan to a customer, they should know about customer well in advance. Okay, so let me see what it is. Know your customer. Know your customer, that is KYC, is an integral part of the credit risk management process and forms the basis for all subsequent steps in the lending process. So that's what I said. Before lending a loan to a customer, company or financial institution, it may be a bank or any other non-financial organization, has to know its customers. So that is what a credit worthiness or whatever it is, they has to know the customer information. This is a basis for all subsequent steps in the lending process. And on the one hand, this involves, that is know your customer, involves mandatory verification of new and existing customers credentials to prevent money laundering. So here the terminology money laundering, you might have heard this word money laundering. See, money laundering is the process of making large amounts of money generated by a criminal activity. This is one unethical activity, unethical issue. See, so some people going to do these activities, there is money laundering and all. So this know your customers is mandatory even for existing customers and new customers. For what? To get to know their credentials, to prevent this kind of money laundering activities. And this, in other hand, it is also important to collect accurate timely information to establish a solid client relationship, so that the bank can position itself as a financial advisor and provider of financial products and services. By knowing the customer well in advance, the company or a bank can provide their customers, that is financial products and services. And this is important to collect accurate information of a customer, timely information, and the two which helps to make a solid client relationship, and so that the bank can position itself as a financial advisor to the customer, as well as it can stand as a financial provider of financial products and services to its customers. So that it is very important to know the customer well, that is know your customer. And second step is analyze non-financial risks. Not only a financial risk, even the company, a bank or financial institution also has to know about non-financial risk included in that transaction. In addition to a credit worthiness assessment, qualitative criteria play an important role in assessing the future of a company. So before lending a loan to a company, organization, financial institution has to verify with the credit worthiness, and has to assess that credit worthiness. Even qualitative criteria play an important role in assessing the future of a company. Qualitative criteria means, so just they are going to assess when there is no time and money to conduct a quantitative analysis or quantitative assessment, they will opt for qualitative assessment, which will leads to and which will give numeric results or a way of gathering information. Okay, this is qualitative criteria in this sense. So this is a way of gathering information which is related to customer. Okay, so and nextly, so among the qualitative rating criteria, that is soft factors, are non-quantifiable criteria that can have a lasting adverse effect on company development. See, qualitative rating criteria is the non-quantifiable criteria, so that will leads to long lasting adverse effect on company development. And nextly, here the financial institution pays special attention to analyzing success criteria which are important for the future development of the company. So financial institutions pay a special attention to what? To analyze the success criteria of the company to which they are going to lend a loan, which are important for the future development of the company. See, this is analyzing the success criteria is important. That success criteria is important for the development of the company in future, so that has to be analyzed. And nextly, factors such as management, competitive situation, and market position, that is local competitors, market share, competitiveness of services, etc., and industry, are assessed qualitatively. See, these factors should be assessed qualitatively, which means, so this is a way of gathering information. Qualitative assessment is nothing but way of collecting the information of a customer. Okay, so instead of quantitative assessment, the financial institution will go for qualitative assessment to search for factors such as management, competitive situations, and market positions and all. Okay, and nextly, these soft factors usually allow the bank to predict future corporate crises with a longer lead time than is possible with quantitative criteria. See, if they go for quantitative criteria, it leads more cost, it incurs more cost for the financial institution. Instead of that, they'll go for qualitative analysis, and these soft factors such as management, competitive situations, and market positions of a company, so usually allow the bank to predict the future corporate crisis which will going to happen in future. Okay, so that they're going to conduct a survey and they're going to analyze the credit worthiness of the customers through qualitative criteria and qualitative analysis. So this is what an analysis of the non-financial risks included in the transactions. And third one is understand the numbers. Understand the numbers in the sense each and every aspect they are going to scrutinize. Establishing a banking relationship and granting loans is associated with various advantages but also the risks. So here we need to understand is, so the banking relationship, establishing a banking relationship with one company and granting loans is not a big deal, and that is associated with various advantages as well as risks. Okay, and that lenders should therefore know how and for what the requested funds are used and how they are expected to be repaid. Lenders, there is a financial institution should verify that what the requested funds are used, for what purpose they are using the funds, and how they are expected to be repaid, in what way they are going to repay that amount, that has to be understood. And in addition, all risks associated with the customer should be identified, categorized, and prioritized in the credit risk management process. So each and every risk associated with the customer should be identified, should be categorized, and should be prioritized in the credit risk management process. Everything has to be categorized, identified, and prioritized. And in order to understand the figures, the focus should be on the company's financial performance. To this end, the company's economic situation is to be examined. In order to understand the credit worthiness of the customer or credit worthiness of the company, the financial performance should be analyzed. To the end, this financial institutions going to examine the company's economic situations well in advance. Company economic situations is to be examined to know the financial performance of a company. Okay, so this is what understanding the numbers. And documents relating to the company's net assets and earnings are analyzed. These documents, whether that company is ethical or not, whether it is legal or not, so that has to be verified. Documents relating to the assets of that company has to be verified, and even earnings are analyzed. And these documents are generally current annual financial statements, business evaluations, or as necessary net income statements. So they has to verify all these statements, financial statements, business evaluations, and income statement, and everything has to be scrutinized, verified. Documents is to be verified to know the numbers of the, to understand the numbers, or to know about a company. And fourthly, give the deal A price tag. Deal A price. What it is, let me see. Setting an appropriate price is one of the key elements of credit risk management. So it's ratings. So give the deal A is nothing but giving a ratings to the company to based on the credit worthiness. So setting an appropriate price level. Price is one of the key element of risk management. It is better to manage the risk if we know the ratings, appropriate risk involved in transactions. Qualitative and quantitative evaluations form the basis for assessing the risk associated with the granting loans to other company. See, even qualitative as well as quantitative evaluations, so base for the assessing the risk which is associated with the granting loans to a company. To know that, we have to rate that. Rating procedures or other evaluation models are used to assess risk, which is used in turn to calculate the interest rate. This DLA price tag is used to fix the interest rate and to calculate the interest rate. Okay, see, a number of complex factors determine the final interest rate. Various factors will determine the interest rate, final interest rate. Among the most important are the company economic situation. Company economic situation is the one factor, and collateral provided by them is one factor which is taken into consideration for granting a loan. Company's economic situation, which means credit worthiness, and collateral provided, so value retention of collateral. So collateral means this is something pledged as a security for repayment of loan. So that has to be verified. Okay, so based on that they can give a ratings. So the principle is, the better the financial situation of the company and the more valuable the collateral provided and the lower the interest rate. If the company position is good and the asset collateral is good, collateral provided is good, pledging the assets is good, the lower the interest rate. Interest will be low. The interest rate assigned ensures that the financial institution is adequately compensated for the risk associated with the transaction. So here the interest rate will decide how the institution is adequately compensated the risk is associated with the transaction. And let's say next one is present and close the deal. After verifying, after rating the company, next is the present and close the deal. The well founded and professional communication of the rating and scoring results and the costs is an important prerequisite for the deal being accepted and concluded. So this presenting a deal and closing the deal, so after the ratings, after the scoring results, so it is important prerequisite for deal being accepted and concluded. Credit decisions should not be made solely based on credit ratings. It should not be based on only the credit rating. Even qualitative and quantitative analysis should be taken place, and this would not be complete without an equal emphasis on qualitative elements such as the competence of management, the competitive, etc. So which means present and close the deal would not be a complete without an equal emphasis. Equal emphasis is nothing but collateral should be there. So on qualitative elements such as competence of the management and the competitiveness, everything has to be verified. Competence of the company, competence of the management, competitiveness of the organization has to be verified. When analysis, structuring and pricing are completed, there is nothing else in the way of concluding the transaction. So after verifying and after analyzing, our structuring and pricing are completed, so they can easily lend the loan to that particular company. And finally, monitor the business relationship. After lending a loan, after a deal has been accepted, monitor the business relationship. In today's competitive environment, banks cannot afford to wait for repayment for their loans, expecting customers to actively ask for other products and services. So competitiveness, there is more competition in financial institutions. They can't afford to wait for repayment of their loans. So rather than they are expecting customers to actively participated for the actively participated in the other financial further activities and ask for other products and services of the lender. In order to maintain its market position, a bank must continue to monitor the client's risk profile, looking for opportunities to develop and expand the relationship with them. See, in order to maintain a good relationship with the company and good maintain its market position, so financial institution has to continue with the monitoring the client and the monitoring their risk profile and looking for the opportunities to develop them and to expand the relationship with them. And this is important. Profitable relationship can quickly become an unprofitable one. Some situations will arise where the profitable relationship may be quickly become unfortunately become unprofitable one. Even when loan payments remain timely, deterioration of collateral, untapped potential, or unpaid taxes can pose a serious risk to a bank. If the customer won't pay taxes on time, and even their collateral deterioration or untapped potentials, so that will lead to a serious risk to a bank, so that they has to monitor periodically. Periodic reviews, evaluations, and audits can ensure that the client remains profitable for the bank in the long term. So because of this reason, periodic reviews has to be taken, periodic evaluations and audits should be conducted, and that will ensure the client remains profitable for the bank in the long run. Okay, so this is what the elements of risk management and the risk management credit risk management and the elements of credit risk management. Thank you all, hope you understand. Jai Shri Gurudev.